Module 3 continues with the recording of transactions using the journalizing process. These transactions, however, are specific in nature as they are called adjusting entries. Adjusting entries are necessary in order to bring certain account balances up to date prior to creating financial statements. Adjusting entries are necessary to comply with the matching principle. The matching principle states that revenues and expenses should be recorded in the period in which they are earned or incurred. If this principle is not adhered to, the financial statements will not accurately reflect the activity of the period. The matching principle is critical to accrual-based accounting that recognizes revenue when it's earned and expenses when they're incurred. Every adjusting entry affects at least one income statement account and at least one balance sheet account. Remember that income statement accounts are revenues and expenses, also known as temporary accounts, and balance sheet accounts are asset accounts, liabilities accounts, and owner's capital account, also known as permanent accounts. There are 5 different categories of adjusting entries. Here we see that we have prepaid expenses, unearned revenues, accrued expenses, and depreciation. Don't be too concerned about the type of category for each adjusting entry, but focus more on getting the journal transaction correct. We'll discuss each of these 5 categories in a little bit more detail now. Prepaid expenses are initially recorded as assets, but become expenses as time passes. Examples of prepaid expenses are prepaid insurance, prepaid rent, and supplies. Here we see a typical journal entry for supplies when supplies are purchased. When we buy supplies on account, we have a journal entry that we debit supplies for the amount that we've bought, the asset that we have, and a liability, a promise to pay back in the future the purchase of those supplies. As time passes, supplies are used and we need to expense those supplies that have been used. The adjusting entry for supplies is the amount of supplies that are used over the financial period. Transactions can be stated in 2 different ways, and sometimes it's confusing, so you have to be aware of how the transaction has been stated to you. One way is that they might tell you that the supplies that have been used for the period are $1,350. In this case, no calculation is required to determine your adjusting entry. It's simply to debit supplies expense for $1,350 and credit supplies for $1,350. But oftentimes the transaction will be stated something like this. The balance in the supplies account at the end of the period is $2,000. And in this case, we must calculate the amount that has been used. Here we see in this T account the initial transaction, the debit of $3,350 when we purchased the supplies, and we see the ending balance that was given to us of $2,000. And in order to figure out the adjusting amount, we need to take the total amount of debits in the supply side, which is $3,350, and subtract the ending balance from that to figure out how much credit we're going to have to supplies in the adjusting entry. And in this case, it's $1,350. Here we see both the initial journal entry at the top to record the purchase of the supplies, and at the bottom we see the adjusting entry to reduce the amount of supplies that have been used, giving us a balance of $2,000 after we record both of these transactions, a debit of $3,350 to supplies and a credit of $1,350 to supplies. And here we see one last look at that T account showing the debit to supplies, the initial entry of $1,350, the adjusting entry, the initial entry of $3,350, the adjusting entry of $1,350, and the balance in the account of $2,000. The next category of adjusting entry is unearned revenues. They exist when cash is received in advance of services being performed. The items are initially recorded as liabilities and become revenue as services are performed, or earned rather. Examples of unearned revenue include unearned rent and unearned fees. The example I like to use here is one of an attorney that requires a retainer be paid prior to handling a case. The client pays the attorney prior to the attorney earning the money. So we have an initial transaction that records the money being received, an adjusting entry that is made as the attorney actually does work and earns the money and records it as revenue. Here we see another typical unearned revenue example where rent is paid for more than 1 month in advance. In this example, the business is the one providing the place to rent and receives the money in exchange for providing a space for someone else to rent. When the payment is initially made, the following journal entry is recorded. We debit cash for the amount, in this case $2,500, and we credit a liability, unearned rent, for the same amount, a promise that we will provide a space for someone to rent in the future. And until we actually provide that space and they use it, we don't actually earn the revenue. As time passes, we do earn the revenue. In this case, 1 month has passed. They paid us for 2 months worth of rent in advance. And so 1 month has been earned, half of that, $2,500. And so we now debit our liability, showing we have provided the promise that we made, fulfilled it for the 1 month, and we record revenue that we have now earned 1 month's worth of rent. Don't be confused by the fact that we have unearned rent as a liability account here, and that we had prepaid rent as an asset account in the prepaid expense discussion we just held. The prepaid rent is this account where the business is paying someone else rent. The unearned rent account is when someone is paying the business to rent a space from us. Two different situations entirely. Here we see the T account showing the initial liability recorded as a credit, and the revenue is earned, and as the revenue is earned, the liability is reduced with a debit entry showing that we still have a liability of $1,250 that we owe to the renter for providing at least 1 more month's worth of rent to that particular renter. The next category is accrued revenues. Here, revenues have been earned but not yet recorded. This typically occurs when work has been performed but we have not yet billed clients. And usually this situation comes at the end of a physical accounting period where we've done work, we haven't sent the bill out, but we have completed the work and earned the revenue, and now we need to record that to accurately reflect the revenues in the period in which they are earned. Even though we won't be paid for the work until the next accounting period, we've earned it and we're going to record it. This involves typically the same journal entry over and over, and that is to debit accounts receivable and to credit fees earned, or some other revenue account. Here we see a typical journal entry that would record this transaction. In this case, $12,275 debit to accounts receivable, and our revenue account in this case is fees earned. The next category of adjusting entry is accrued expenses. Accrued expenses are expenses that have been incurred but not yet recorded. The most common example is when wages have been incurred but have not been paid or will not be paid until a future financial period. Typically, this again happens at the end of an accounting period when employees have worked and earned wages, but their paycheck is not going to be paid until the next financial period. For example, the year ends on a Wednesday and employees are paid on Fridays. The expense for the wages of Monday, Tuesday, and Wednesday are in one financial period, but the paycheck will actually be paid in the next financial period. The journal entry to recognize this event is to debit wages expense so that we record the expenses in the period in which they were incurred, and to credit a liability, a promise that we are going to pay those wages at the end of the week, in our case here, on Friday when they receive their paycheck. So once the wages are paid, we would then debit the liability to remove it and to credit cash as we pay it out. The last step in the adjusting process is to remember that journalizing adjusting entries is only half the job. Just like all journal entries, they have to be posted to the general ledger in order to achieve their goal of updating the balances of accounts, okay, and to reflect the activity and achieve the matching principle. The last topic in this chapter deals with the adjusted trial balance. The adjusted trial balance is just like the unadjusted trial balance that we learned about in Module 2. The way we create it is exactly the same way. We list our accounts in numerical order and record the balance in the account after we have posted the adjusting entries for our individual accounts. So we have a cash, we record the debit balance for cash, accounts receivable, that debit balance, we list all of our assets in numerical order, the debit balance. Be sure to include in this listing for the adjusted trial balance not only the equipment, but also the accumulated depreciation for the equipment. And that the equipment account will have a debit balance. In our case, our example earlier, our equipment was a $15,000 debit. And the accumulated depreciation on equipment will go in the credit column because the normal balance of a contra asset account is credit. So we will enter in our credit column on the row for accumulated depreciation for equipment a credit of $5,000 from our example. Other than that, the adjusted trial balance is just like the unadjusted trial balance. It's a matter of timing as to when we create this trial balance. And it's after we have completed the adjusting entries and we have posted the adjustments into our general ledger so that our balances have been updated and we have new balances. One last note about adjusting entries. Every adjusting entry will include at least one balance sheet account and at least one income statement account. I think we said that earlier, but it's very important when you're doing your adjusting entries that you don't have two balance sheet accounts because it won't be a valid adjusting entry, or two income statement accounts. We need one of each. There's no rule about which one has to be the debit and which one has to be the credit. You're simply going to have to do some adjusting entries and make sure that you read or listen to the next lecture on the sample problem for adjusting entries that will help you learn how to do them. Now, once a company goes through the initial financial period, the adjusting entries will generally repeat after the end of each financial period. So once you've figured out what the adjusting entries are, the next time you come to the end of a financial period, you're generally going to have exactly the same adjusting entries. The amounts will be different because depreciation will change as periods change. The amount of supplies used up will change. But those accounts that need adjusting entries will typically repeat every financial period. Remember, adjustments are necessary to accurately reflect the revenues and expenses in a financial period. This concludes our discussion on adjusting entries. Look forward to meeting with you next time.